Hello and welcome to Startup Europe, the Sifted Podcast. This week we're back with a longer form interview and today it's someone a little bit different. Sonya Iovieno isn't a founder or a VC. She's head of venture and growth at HSBC Innovation Banking, formerly Silicon Valley Bank or SVB. She and her team work with thousands of VCs, startups and scaleups in the UK and Nordics to help them manage their money. And that means she has a bird's eye view of what's going on in the ecosystem today, which we'll be getting into on the pod in a moment. Many of you will also remember the drama-filled weekend in March of this year when SVB collapsed after panic in the VC community triggered a bank run as customers of the bank began to withdraw their deposits en masse. Amongst other things, the story showed us just how fragile the startup ecosystem can be, with many startups using SVB as their only bank account, while VCs also relied heavily on the institution for their own finances. So we'll be talking about all of that with Sonya in just a moment. It's been a pretty wild few years in Startup Europe. Big boom, slow bust. What is your best prediction of what next year will look like?
Oh gosh, you're going to ask me to take out a crystal ball, which I don't have. I guess all I can say is to reflect what I'm hearing in the market. And as you say, we spend a lot of time talking to VCs and trying to judge the temperature, how they're feeling. I would say if you asked me that question in the summer, a lot of people were saying maybe by the end of this year, Q1, they thought the market would start to open up again. I think that has changed. It's clear that interest rates, while they may be at the peak, are staying higher for longer. And even though there's lots of capital out there and there's no pressure on VCs to deploy, I think now they're starting to say it's probably going to be towards H2 next year. When they really start to open the taps. But that said, we can already see VCs in the US and in Europe start to deploy new rounds to the best growth stage companies, so Series B, Series C companies, pretty much, I suppose, exclusively in the hot areas like enterprise software, climate tech, AI, as well as life sciences, bioscience are pretty hot. So the bar is high. But we think that there's going to be continued confidence in those sectors.
And what about, I got a PitchBook report this week, which suggests that it's kind of finally filtered down to pre-seed and seed, where valuations are taking a hit. Are you seeing that? Is there kind of less activity there now? What's going on at the very earliest stages?
Yeah, I think that's true, actually. It was very interesting to see just how quickly the US market responded to the changing interest rate environment, and that trickled down very quickly to seed and Series A. That didn't happen for a good 12 to 18 months in Europe and the UK. And it was sort of surprising that angel investors and seed investors didn't seem to feel that valuations needed to be adjusted at that stage. And I think that has definitely changed in the last 6 months. So I think, yes, we're seeing fewer investments. Some of them are larger rounds though, so I think that maybe those companies are a little bit more robust and the diligence is a little bit deeper. But there certainly has been a right sizing, if you'd like to call it that, of valuations at that stage. And I think that was really important. That had to happen for the whole ecosystem to have confidence to move forward again. And that was probably one of the things potentially holding back growth stage investors from having confidence in, looking at new rounds and up valuations for Series B companies in particular.
Do you think we're done with the valuation downsizing, or do you think there'll be more of that in 2024? Because it still feels down rounds are creeping up as a percentage. But I don't know, to me it still feels like there hasn't been enough publicly announced companies taking big valuation haircuts, for example.
Yeah, and it's interesting because not all funding rounds have been made public. So internal rounds, particularly if they are done with a convertible loan note rather than straight equity, not all of those would have been announced, and they certainly were mostly down rounds. I don't think we're done at all. No, I think companies have been supported for quite a long time with internal rounds by VCs, and that's going to take a lot of companies through to Q1, Q2 next year. And when they do go to market at that stage, they'll still have to reflect where the valuations have gone, and that is going to look at more down rounds, yeah. But I think, it's a mixed picture. So some companies certainly did take their medicine over the last couple of years and have been very, very focused on unit economics, driving towards profitability and at the same time investing in the right areas for continued growth. So I don't think you're going to see a universally sort of consistent picture across the piece. It's going to be some companies that are still going to have that that moment of realising that valuations where they are not where they want them to be, while others are definitely well positioned actually to benefit from an up round.
Okay, so it's kind of they've all been sort of undercover for a year and they'll go out to fresh new investors, and some of them will have really kind of tidied up the shop and others will not be quite there.
Yeah, I think so. I think the other thing that we're going to see much more frequently is that, as I said, VCs have been really good actually, really since COVID, at supporting almost 100% of their portfolio companies with additional equity in one form or another. I think those days are over. And, they're going to be very judicious about where they put their capital. And so it's very important for founders to know where they sit within the ranking of the portfolio of their investors. And those that are in the bottom 25% really will need to look elsewhere probably for additional capital.
How do founders find that out? Do they just ask VCs straight up?
Yeah, I think some VCs will be quite open about it. And obviously, if they are, that's to the founder's benefit. Certainly, if they can be open about it, well in advance and allow a founder to plan. I mean, really, founders should be doing their research to understand what good metrics look like for their type of company at their stage in this market. And that will tell them how far or how close they are to that kind of performance. And if they have a number of different areas where they're falling below whatever the standard is in their particular market, whether they're a consumer or enterprise software or hardware business, then they certainly need to be looking at what levers they can pull in their business to try to tighten the performance, and certainly to start talking to other external investors and get feedback on their company. If they start talking to external investors, they should get a good feel for how enthusiastic or not they are for a new potential investment.
Yeah. And what have most startups been doing over the past, I guess, 2 years? What have been the main levers they have been pulling to kind of, trim things down?
Yeah. I mean, I think we see a few things. So if you went back to the heady days of 2020, 2021, it was pretty normal for a startup to raise a round and then instantly expand into 5 different countries at the same time. And what we've seen them do is pull back that resource and really focus on core markets and going deeper in core markets. Whether that's the UK or European markets, US markets, it's where they already have a solid footprint, where they've got the ability to prove out those unit economics, and where they've got loyal and sticky customers that they think they can continue to grow and expand with. So yeah, certainly geographic expansion is something we've seen being pared back. Obviously headcount follows in that train as well. And I think we've seen a mixed response, I would say, in terms of where the headcount is being trimmed. Certainly developers, but also sales staff, where the focus has been less on top line growth and maybe more in unit economics. I think the really thoughtful companies have been careful to keep a certain level of sales staff going and making sure that while they're focused on the unit economics, they can actually show that the company will still grow. And then other areas that we've seen them focus on is less on maybe the marketing spend and more on building the tech stack and making sure that their tech stack really works and that it's ready for expansion when they're ready to push the button.
Interesting. Yeah, we had Reshma Sahoni from Seed Camp on the podcast a few months ago, and she said the thing most of her portfolio are really focused on now is keeping their customers.
Yeah.
So it's not necessarily growing. It's trying to keep the ones they've got and get more value out of them, which is a very different focus from a few years ago, isn't it?
Yeah, and that's sensible, right? If you're looking at building a sustainable business, making those customer relationships as sticky as possible and reducing churn is what's going to really underpin your business when you're ready for expansion.
How would you say the state of startup finances are in general at the moment? Would you look at some of their accounts and think, uh-oh?
Yeah, I mean, I think overall, not too bad considering everything that's happened in the last 18 months or so. And I think, a lot of that is down to experienced founders. We're seeing far more companies these days that have second and third time founders on their teams, and experienced investors as well that have been guiding through this period. Certainly there are going to be those that just haven't reacted quickly enough. And I think they're the ones that are really going to find that they have to double down and overachieve in the next 12 months if they are going to achieve another round. We do expect that there'll be consolidation across all of the sort of innovation sectors. Certainly we've been busy over the last 12 months putting what you call hunting lines, debt M&A lines in place for growth stage companies who see that opportunity. And I'd say we haven't really seen them used very much so far. My reading of that is that we haven't really had a meeting of minds between those companies and founders who haven't been able to grow into their previously high valuations and accepting that the valuation landscape has changed. And so they haven't been able to come to the table for any sort of a deal, whether it's an equity deal or otherwise.
Do you think next year when those companies go out to new investors, get revalued by those investors, then we might see the M&A pick up because they'll have had that kind of reality check and know what the company is really worth, what their funding options are, and maybe they think getting bought or merging with another company is actually a better option.
Yeah, undoubtedly. And I think we are already starting to see some conversations happening. I think if you're a founder in that position, the best thing you can do is start to explore the market before you're down to your last few months of cash runway. I mean, these are cash burning businesses. And so, to maximize your negotiation position, you want to be going out from a position of strength. And so there certainly will be those that leave the timelines quite tight, and that will reduce their negotiating power. But yeah, we do expect to see more of that activity next year.
And the growth stage companies you're working with that are sort of putting things in place to be able to acquire companies, are there any sectors in particular or any types of company in particular that you think will do more M&A than others?
There's certainly a lot going on in enterprise software and also some of actually the B2C companies, which is quite interesting because B2C hasn't been flavour of the month recently from an investor perspective, but a lot of those companies did raise big rounds back in 2021, more than enough to see them highly liquid in the current environment. And then the same is obviously true of enterprise software. I think we'll see quite a bit of consolidation in cyber. I think there's a lot going on there and some good quality assets that maybe haven't optimized the investment that they got. And then I also expect to see quite a lot of activity in fintech, in open banking and related services. Yeah.
And in terms of debt, people are obviously setting up debt lines to buy companies. What else are people using debt for at the moment, or is debt not as popular as it was?
Debt is much more popular than it was, I think, for a few reasons. Obviously, the closed or relatively soft equity markets means that founders are looking at different sources of capital, and debt is one of those options. I think as well, particularly in Europe, the whole ecosystem has become much more educated and knowledgeable about debt and more comfortable with it for loss-making companies than maybe 5 or 10 years ago. And so in the US, for many years, it's been almost a normal part of any equity raising that you would put a debt line alongside. That hasn't been the case in Europe. But now we are seeing that companies that have sort of 12, 18, 24 months of liquidity are saying, well, I'm quite unsure about what the equity market is going to look like next year. So we'll put a debt line alongside for insurance policy, extended cash runway. And I think it's also, even still in this market with interest rates, a cheaper source of capital and less dilutive than looking for an internal CLN from equity investors.
Do you think investors or founders really thought hard enough about the fact that interest rates were obviously going to go up from the really low rates they were during COVID, and what kind of impact has that had on both investors and startups?
Yeah, they certainly thought about it. Conversations that we would have had 2 years ago when putting new debt facilities in place often centred around, whether there was a cap on the interest rate and whether that was an option that the company could explore. So it was on the table. I just don't think anyone expected the rates to rise as dramatically and as quickly as they did. I don't think we've ever seen central banks take action that quickly, actually. And so there was no known, I suppose, parameter or frame of reference that would have had that kind of scenario testing for companies.
What, aside from money concerns, what are the top concerns of the founders and startups you work with at the moment?
Yeah, I think certainly sources of talent, which has obviously long been on the radar, remains on the radar. Most of the companies we talk to are very flexible in terms of where they hire people, and I think hybrid and remote working has been a feature for a lot of them, and so that has eased it to some extent. And I think the competitive environment is something that they're very concerned about, particularly if they're selling into large enterprises. The sales process is taking months longer than it did. That probably relates back to financial concerns and making sure they have the runway to sustain that. But also I think, making sure that their product really resonates and that the demand drivers are there for the investment that they're making. It's a competitive environment still, and making sure that they have the packages that attract the best salespeople and the best developers, while still keeping an eye on those unit economics are a real area of focus. And then I think they're very cognizant of things like marketing spend and SEO and investment generally, and making sure that each marginal dollar or pound or euro that they're spending is actually giving a higher ROI for the business as a whole. So back to business basics, I guess, in many ways.
Which members of the C-suite would you say are most crucial at the moment, or do most founders, care most about getting right?
That's a really interesting question. I'd probably rephrase it and say that it's less about individual members and more about harmony and a shared vision. Look what's happened with OpenAI, I guess, at the moment, what's happening across like non-communication across the board. And so I think having really close communication and agreement in terms of the steps that a company is going to take. Companies have been asked to pivot at least 2 or 3 times in the last 3 years. And that's quite a difficult thing to do as you grow a company. It's a bit easier when you're a startup, but you really need to have consensus around the board of, what the direction of travel is and how it's adding value and what good looks like. And so, I think it's about making sure you've just got the right talent and that communication in place.
And what about VCs? We've spoken a lot about the startups. What's been going on with VC finances this year?
Well, VCs have been busy. They've been fundraising, and we think they're very well placed. I mean, a lot of the big funds around Europe, Northzone, Atomico, Dawn, Notion, have all raised new funds. So they are ready to go. I think if you're a founder looking at that, you want to be in the new fund and not in an old fund that they're closing out. They've obviously been having a lot of conversations with LPs around, what the return model is like, what kind of companies and sectors they're going to invest in. And I think overall there's, some positive movements in the UK in particular, with conversations around pension funds and opening up the sources of capital for the community as a whole. Interesting conversations, and VCs are very excited about what they're seeing in Germany, and opening up the ESOP schemes and, moving around the sort of the tax play on that side. So there've been a lot of conversations, I think, between VCs and policymakers to make sure that when the whole ecosystem turns the corner, that it's ready to optimize it. The other interesting feature we've seen in Europe is that despite the downturn at the moment, we have continued to see US VCs move into London and take a continued interest in Europe. So I think that plays out really well for sort of the long-term outlook for the sector here.
Yeah, we did a survey a few weeks ago asking VCs about their relationship with their LPs, and over 50% told us they've returned no money to their LPs this year. Would you say that tallies with what you're seeing, and is that very unusual from previous years?
Well, I think we're in unusual times, and I wouldn't say that 2021 was usual either, nor was 2020, and I think we're really seeing a rebasing of the market to what was normal back in 2019, maybe early 2020. And so, LPs are invested across a range of different capital structures, not just VCs, but private equity, and other private markets around the world. So I think there's a good understanding of the dynamics at play. What they're really interested in is making sure that VCs are managing the portfolios that they have to optimize them, and that's probably going to play into some of the M&A decisions you're going to see next year, where there actually will be a sale mandate maybe a year or two than a founder might otherwise have expected, as they start to return the investment in those funds. And then I think, yes, it's taken a while, but over the last 12 months, LPs have certainly been focused on, when is the right time to buy into the market, which is probably why you've seen so many of these new funds being set up.
Yeah. So in terms of VCs managing their portfolio, what does good look like when you kind of look at some of the funds that are best performing or best regarded? Are they kind of reasonably regularly selling their stakes in startups, whether that's through M&A or secondaries or not an IPO at the moment, but what does that kind of, how does a good fund make sure it manages its portfolio to ensure that, you know, it does actually make those returns within the time frame it's agreed with its LPs?
Yeah, I suppose it comes down to a number of factors. Certainly the fund will have a certain lifespan, and, you know, you'd expect that for most funds, they wouldn't be selling companies inside 5 years. Now, again, 2021 was the exception in that regard, but you're usually looking at a 5 to 7 year timeline before these companies are ripe for the sale. You know, what you'll see with a good fund is the ability to open up the market for companies to take new investment and to capitalise the investment they have. So you will see really great investors bringing in the next round of investors nice and early, not just when they are ready to raise an equity fund. And that's what builds the supercharged unicorns that we see and the really fast growing companies. I think they're, you know, a good fund will be really close to their companies and will be able to segment their portfolio or stack rank their companies on a regular basis and have a good view of where valuations are standing and be able to feed that back to the founders as well. You know, my view is that communication is actually really key between the fund and the founders, so that if a founder and a company is doing well, then they can really shoot for the stars and rely on the VC to make those introductions and know what the path is. But equally, if they're hitting a boulder on the road, that the VC is bringing expertise around the table to help them navigate that. And then we spoke earlier about companies who just maybe aren't able to execute. They're in that bottom 20-25%, but also, you know, being very clear with those companies about what they need to do to maximize valuation. But being open to what the exit path is and understanding the markets in that regard is certainly very important, so that they can execute the right sales at the right time.
Smart. What are VC's biggest struggles at the moment?
Well, I think they're clearly very, very focused on valuations and making sure that they are optimizing those companies in their portfolio and giving them the right guidance. And that's not as easy as it sounds. You know, I think 12 months ago, the guidance was very clearly focus on your unit economics, focus on preparing your company for driving towards profitability. Now that has changed a little bit, I would say, in terms of continue doing that, but we also need to see growth in these companies, because that's how you're going to attract the next round if you're up for another equity round or sale. So I think, you know, we see VCs working very, very hard at the company level. But at the same time, they are being challenged. As we said before, a lot of them have new funds, and so they're spending time out in market trying to gauge which are the best companies that are going to be a good fit for their portfolio. So we see a lot of VCs talking to each other and sense checking what they're hearing in the market, how they're judging different companies. They're spending a lot of time with founders. And they're working with their ICs to sort of get a feel for what's the right time to start really opening the wallet and making those investments.
Interesting. And in terms of VCs themselves fundraising, I've spoken to lots of people who've said they expect there'll be a whole load of maybe especially emerging managers, so VCs on their first few funds, not be able to raise their second, third, fourth fund. Are you seeing any signs that that's likely to happen?
Yeah, I think it's possibly a bit early, and timing is everything. A lot of the emerging managers started their funds in 2021, so they've got a bit of road left before they're under pressure to start looking for the second fund. I mean, there certainly is a flight to quality in all parts of the market, and that's true for LPs too, right? It's a much less risky proposition to go and invest in a fourth or fifth fund than it is in a second fund. And a lot of the first funds haven't yet had the opportunity to maximise the output and show the track record. Now, having said that, if you're an emerging manager and actually your GPs and your investment partners are very experienced, then I think you're better positioned to be able to, you know, have that conversation. But it's certainly going to be more challenging for an emerging fund than it is for an established one.
And on the subject of the most popular sector of all right now, AI, what are some of the craziest things you've seen happening there?
Yeah, I mean, interestingly, we don't even view AI as a sector. It's a little bit like what was the internet. It wasn't a sector. We see it crossing every single vertical and subsector that we have. It's hard to tell at the moment. I mean, certainly it'll be interesting to see what happens with the fallout of OpenAI and really understanding. I mean, they had a very different company structure, but really understanding in such an important market player, you know, what happens there and more importantly, what is going to happen in the future. So I think there's just a mixed array of what we're seeing across investment in AI. It's been pretty rapid. A lot of these companies are very, very early. So I think you have a handful of companies that have genuinely been under development since 2014, 2015, and there is deep tech and great AI value coming out of those companies. And then you have those who've literally bolted AI onto the back of their name. And that's down to investors to have a really good understanding of what it is they're investing in. So again, taking out my crystal ball, it'll be interesting, but I think there's a general expectation in the market that there might be some fallout over the course of the next 12 to 18 months that really shakes out that industry and shows, you know, what are the good performers from the average. And I think that will have to right-size valuations accordingly.
Yeah. And then another area where we have, especially at the later stage, seen lots of investment is climate tech, especially the kind of very hardware, very infrastructure climate tech. What's your crystal ball prediction for that sector next year?
Yeah, I'm quite positive about it. We've invested heavily in our climate tech team and brought in a new director of climate tech recently. So it's an area where we're all in because we think that all of the dynamics, all of the drivers are lined up to say it's going to be a long-term area of growth. And we see quite a mixed picture, I think, in terms of, you know, what investment looks like in Europe. In the US, I'd say it's very hardware heavy. And in Europe, it's still the case that if you look at company numbers rather than round size, about almost 40-50% of them are actually enterprise software companies. They're not hardware companies. They're data analytics companies and insights and data management tools, maybe reporting tools. But I do think that we're going to see a big charge in the next few years around EV and battery. And they are big, large-scale projects that take a lot of capital. They take 4 or 5 years to really get set up and optimized. So an area there which is going to be for long-term growth. And in some ways, regardless of government policy, you know, consumers are voting with their feet and they're out there buying sort of hybrid cars and electric cars and so on. So generally speaking, you know, industry is obviously very interested in it. There's no board of a large company that doesn't have ESG as part of their reporting. And as they build out their own logistics, distribution and office footprint, it's all going to be a part of their story. So yeah, we think that every area of climate actually is going to be pretty interesting next year.
Yeah, and it'll be interesting as well how they get financed. Because they can't just rely on, especially the hardware ones, they can't rely on solely VC. We'll see a whole mix of government, corporate, debt, whole mix of things, right?
Yeah, I mean, this is an industrial revolution, and I think you have to have industry, commerce, government, universities, finance providers all locking arms and coming up with solutions and schemes that supports those companies because, you know, they are going to be 4, 5, 6 years before they're commercially viable, and we have to make sure that what they're producing is fit for the market as well. And part of that is legislation that has to sit behind it. And I think, you know, it's taken a little while, but it does seem to be resonating now with governments across Europe, and we are starting to see that investment.
Yeah. So to put away the crystal ball, take out the time machine. So if we go back to March, that was a pretty wild month for your team, lots of startups teams, our team, me and Tim, who's sitting in the room here, our pod producer, were there all weekend reporting the story. How did it feel going through the roller coaster that was that Silicon Valley Bank weekend and the weeks that followed?
Yeah, time machine is right. It almost seems so long ago now. Look, I think from being on the inside, it was a pretty unique culture and vibe in SVB. We were a high growth company. We were exceptional and unique in our market, and we understood our markets really well. As someone that was running a business within the bank, I can tell you that the balance sheet in terms of the portfolios was solid as a rock, and we were really pleased with how it was working. So it came absolutely out of the blue. And, you know, in some ways, I think we're still in shock and still trying to understand how such, in some ways, a very basic mistake in terms of investment was made by experienced board members and advisors. But, you know, it felt devastating at the time because as a culture, we were very, very client focused, and everything that we do was about how do we help founders and our companies scale, how do we optimize what they want to achieve, and then to let them down really in that way and have them as stressed and concerned as they were. I would say every single member of our team took it personally, and I was really proud of how the team reacted. We were on the phone morning, noon and night over the whole period with our clients, you know, putting aside our own personal circumstances and concerns to get them any information that we had and advise them. It obviously worked to our favour that we did have such a strong balance sheet that HSBC was able to look in and with a fairly minimal amount of diligence over the weekend have the confidence to bid for the organisation. And they've been, I have to say, absolutely amazing. They've been delighted with what they bought for £1 and the dividends they've already have. But we've been fortunate to be able to spend a lot of time with senior leadership in HSBC and bring them out to introduce them to our clients, to the VCs, to the communities, and see what we do and how we do it. And they're absolutely thrilled and can see that it's something that's quite unique that they're trying to foster.
And how has your, job or your team's work, what's changed day to day since kind of fully integrating or becoming part of HSBC?
Yeah, in some ways nothing has changed. I mean, one of the first things that Noel Quinn, the CEO of HSBC, said was we're going to protect this and nurture it because of what's there now. And so we provide the same products, we have the same risk appetite to the same companies in the same sectors. And that doesn't change at all. And I think it's been a busy summer, which won't surprise you. Bank integrations are complex, and we had a huge project at the back end in systems, moving all of our systems from the old SBC systems onto HSBC and working with our clients to move them off the online banking system in SVB onto the HSBC online banking system. That was done in record time. We did that in 6 months. I mean, usually a bank consolidation would take you 12 to 18 months. So we did that at the end of August. We launched a new brand in London Tech Week with the HSBC Innovation Banking brand. And really we've been working hard to consolidate that and make it resonate around the market. And it was deliberately a brand that we felt could resonate globally because, look, HSBC just thinks globally. And so they didn't buy SVB UK just to have a UK bank, and we're already expanding. We've got teams in the US, Israel, Hong Kong, and then Denmark and Sweden as well within the European footprint. So the ambition is high and there's a lot of work in building that out. But otherwise, in terms of how we face the market and what we do, it's the same. One of the things we'll be doing next year, though, is optimising what we can do at HSBC because they're a much larger bank, and so we'll be bringing more of their banking products onto the platform so our clients can access those as well.
What kind of products might those be?
All kinds of banking products, so different types of accounts in different jurisdictions. They are very strong in Asia, so we want to make sure that we're optimizing that footprint for our clients as well. It's not an area that SVB was particularly strong. They had a Chinese arm. Even in South Europe and around Europe, SVB had to use a correspondent banking system, whereas with HSBC, they have a banking footprint and banking license all over Europe. So clients can now have all of their European accounts on one system. Asset management is an area that we'll be able to expand our offering. We're very keen to work closely with the investment bank and wealth management, which again is an international footprint, to be able to provide the right kinds of products to our clients as they scale, either personally as founders or indeed as investors or for the companies themselves.
Interesting, because I feel like that's something that maybe SVB in the US was doing more of, the kind of personal money management for investors and founders, so that we should see some of that coming in Europe.
Yeah, that's right. We hadn't been able to extend that into Europe, and it was a constant source of inbound inquiry because we we knew that our clients knew that we had that in the States. So we're working really closely with the private bank in HSBC to optimize it for VC-backed companies and VCs. So really excited to finally be able to offer that to our clients.
I guess that's a good sign of Europe's ecosystem as well, isn't it? If founders and investors are getting personally wealthy enough, they need those products.
Yeah, and look, it's really important because for most private banks, they need to see your balance sheet. They need to see you've got cash on the balance sheet, and that's not where the wealth is held by these founders. And in fact, they're obviously encouraged to reinvest in their own businesses and to take equity. They're taking high risks, and so it's important that they can leverage that in some sense and recognise that work in terms of how it reflects in their lifestyle. So that's really what a private bank for entrepreneurs has to provide.
And where in Europe might it make sense to expand into? There was an SVB team in Germany, wasn't there? Although it didn't offer the full kind of package. Where else in Europe might make sense for HSBC Innovation Banking to go?
Yeah, I think it makes sense for us to be where the hubs are, right? So where you have that confluence of founders, supported governments, active VCs, not just local VCs, but international VCs from around Europe, the UK, the US are all spending time. And so if you look at where those hubs are, I think that's really where we need to be closest to our clients on day one and start rolling things out. So I'm not going to give away our strategy straight away, but I mean, you can take out a map of Europe and a pitch book report and probably figure that out.
Noted. Final question. What lessons do you think the ecosystem has learned? What change have you seen come about as a result of SVB's collapse?
Well, I think certainly that communication and integration across boards that we talked about. So there has been a focus on not just focusing on the top line, but actually looking at every aspect of a company, of its governance, certainly looking at cash management and how that is managed and making sure that it's diversified and that it is easily accessible and that there's a clear reporting line up to the board. I think that there's been a ton of reflection, I suppose, in terms of how we build companies in this country and across Europe, and where you're going to spend your time and investment in order to develop a sustainable company. So it's been a little bit of a step back, but probably hopefully to take 2 steps forwards in terms of making sure the fundamentals are right in the company before they rush forward for the next stage and worry about fixing things later.
And do you think it was SVB's responsibility to be encouraging startups to diversify their capital more, saying to them, hey, you've got a lot of your money in just one bank account, you need to change things?
Yeah, I think that's a very fair question. And actually, we worked really hard with our clients at SVB to make sure that they were taking responsible actions. So, for example, we developed a template treasury policy that we shared with our clients pretty much once they raise a Series A, which is the first maybe 5 or 10 million that they raised. And one of the clear call outs in that policy was that they should diversify their cash. To the extent that clients did engage in that conversation, we were able to recommend other providers to them that were providers who were used to dealing, for instance, with VC-backed companies that are frequently changing their boards as they raise new equity, but also raising large amounts and need to find a safe home for them. And we certainly talked regularly with our clients about the importance of capital preservation and finding a safe home for their cash. Ultimately, I suppose there's only so much you can do in that regard, and that we don't sit on the boards and we're not a formal regulated advisor to our clients. But it's a board decision to make. But certainly, it was a conversation that we had regularly, and we had our treasury team set up to engage in those conversations.
Amazing. Thank you so much, Sonya, for your crystal ball predictions and your bird's eye view of the ecosystem.
Oh, you're very welcome. Thanks for having me, Amy.